UnitedHealth Group held a conference call with Wall Street analysts and provided an investor update that sent the stock price crashing by more than 17%. There were two things specifically that sent the stock price crashing, and I'll talk about those two things in this video. But there is also some positives, and I'll highlight those positives that came out of that investor update. I'll also inform everyone what I think about the business longer term if I think this is a buying opportunity. I'll share with you my proprietary discounted cash flow valuation model, which calculates what I believe is a fair value for the stock price today. I'll also look at valuation on a forward price to earnings perspective before I come to a conclusion and give this business a rating on buy, hold, or sell.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the two things that sent the stock price crashing, first of all, was an announcement that Stephen Hemsley will return as CEO, replacing Andrew Whitty. Now, whenever you have a sudden change of leadership like this, a change of CEO, sudden, unprepared, unplanned, unforecasted, that's usually bad news for investors. Investors see that as a bad sign, an abrupt change in leadership. It's going to take time for the new leader to get acclimated with the business, and there are certainly going to be transition headwinds for this business. The second thing that sent the stock price crashing is that the company suspended its 2025 outlook due to, they said, accelerating care activity and higher than expected medical costs for new Medicare Advantage beneficiaries. And if you're wondering where I'm getting this data from, this is FinChat.io. They aggregate a lot of financial information. There's a link in the description for a free 2-week trial and a discount. So they also outlined 3 factors driving their revised outlook, and they were greater than expected impact from the health status of new healthcare members, further acceleration of utilization with Medicare Advantage, and indications of a broadening trend to other areas, particularly among those with complex conditions. So in other words, what the company is saying is they provide insurance, and when people use their insurance, that drives up the company's costs to serve those customers, which then brings down profitability. So while the increased utilization is primarily on the outpatient and physician side, the company's anticipating further spread. So they're not saying that this is all that will happen. This is all the headwinds that we're going to experience, and trying to tell investors that everything looks better after what we've seen here. What they're telling investors is we're being cautious and we're anticipating that these cost pressures will continue. The company aims to return to its long-term earnings growth range of 13 to 16%. UnitedHealth expects to return to its target margin range in 2026, albeit somewhere within the 3 to 5 percentage point range. So this is interesting, right? The return to its long-term earnings growth range of 13 to 16%, they're saying that they aim to do that. That doesn't mean that they will do that, but they're aiming to do that. So I don't take that as being overly optimistic, and I also don't take that to mean overly negative, right? They could have said something like, you know what, we don't think we're going to achieve those types of growth in earnings per share anymore. We just think that the structural changes in our business are so negative that we don't think we'll do that. So they also didn't say that. So that was somewhat positive if you take that side of the perspective, right? Because so many investors took such a negative note out of this earnings call, out of this investor update. Stock price was down over 17%, right? So not very investors took much encouragement out of this investor update. So they're focused on engaging with new patients to address their health needs and prepare for 2026. They emphasize the strength of value-based care and their role despite the influence of all of these regulations. So UnitedHealth Group facing headwinds. Of course, they've been in the headlines for many negative reasons, and the current administration in the United States is increasing scrutiny, increasing regulation, making things more challenging for healthcare companies like UnitedHealth Group. So I can understand a lot of the negative sentiment around this business. I've certainly become less optimistic about healthcare stocks here in the last few months as President Donald Trump and his administration have increased pressure on the industry with more regulation, more pressure to lower prices and make things better for consumers in the short term. But what I don't think is incorporated here is if you force healthcare companies into these unfair, or I don't want to say unfair, but unfriendly circumstances, they're going to reduce their investment, right? Healthcare companies, they invest in processes to improve patient outcomes if they believe that they will profit from those investments longer term. If you lower the healthcare industry's expectations of future profitability, it will lower their investments in those outcomes significantly. So you'll see fewer innovations in the category, you'll see fewer investment. It's a really touchy subject, it's very difficult, but they do provide very high value outcomes that people are willing to pay for, regardless if we're in a recession or if we're in growth. So that part of the business is attractive longer term, but I can understand the stock price decline following today's investor update. So let me share with you my proprietary discounted cash flow valuation for UnitedHealth Group. I have the business, the intrinsic value per share at $684. The current market price is only $311. So it shows me significant undervaluation using my proprietary discounted cash flow valuation, which I also adjusted the beta higher to 0.8. Their actual beta is around 0.6. So I gave an increase in the beta. I lowered the long-term growth outlook, and I've given them a cost of debt of 8.5%, which I think might be a little aggressive given how strong their free cash flow is in every year from, going back a few years and going forward several years. Still, I want to emphasize that my conviction on healthcare companies, on my valuation of healthcare companies, is not as high as in other industries because healthcare companies have different dynamics to how their free cash flow is generated. So much regulatory pressure, so much has to do with their relationship with governments. And so the outcomes are a little less certain when compared to when I'm looking at businesses that are just dealing with market dynamics, creating products that customers like and buy and generating profits while creating those products. It's so different for healthcare companies given their strong relationships with governments and how the relationship with the government can reflect outcomes longer term. Additionally, when I look at valuation on a forward price to earnings basis, this stock is trading at the lowest valuation, a forward PE of 11.5, than any time in the last decade. So at a brief moment in 2020, of course, during the pandemic, the valuation dropped around this level, but it was still higher than where it is now. So the valuation right now is at its lowest point in the last decade. So yes, the business faces greater risks, greater challenges, lots more uncertainty, but you're getting it at a very low valuation. So for all those reasons, I would rate this as a buying opportunity for UnitedHealth Group stock investors. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.